Welcome back to International Finance. I am Andy Kim, your Dr. Finance, and we've been going through Chapter 6 of Eun, Resnick, and Chulun, 9th edition. And in this video, I'm going to talk about the IRP and exchange rate determination, as well as something called the currency carry trade. And we'll move down to finish this IRP concept. Start with IRP relations. Spot rate should be equal to forward rate. Here I said in a year or something, but you can generalize it later. Forward rate times 1 plus foreign currency rate divided by 1 plus domestic rate. Okay. Now it tells that given the forward exchange rate, the spot exchange rate depends on relative interest rates. Okay. It's like other things being equal, ceteris paribus, like partial equilibrium setting. Increase in the US interest rate will lead to a higher foreign exchange value of the dollar, which is stronger dollar that you hear these days, right? Under certain condition, the forward rate can be viewed as the expected future spot exchange rate conditional on all relevant information set available right now. So forward rate is nothing but expected spot rate in the future, given all the information that you have right now. Okay, so that's mathematically shown like this, right? Conditional probability given the information set. Now S1 stands for future spot rate, yeah, in a year. F1, 1 year forward rate, but you can generalize into like T plus N, something like that, right? Instead of 1. Anyway, I0 information set today, right? This is day 0. Nothing complicated about I0, okay? If you try to be mathematical and then go into convolute all this mathematically even more, you can screw up even more. But no need for doing that. What I'm trying to say is those information given, okay? Given those information, what you expect as a spot rate 1 year from now. That is nothing but forward rate, right? So sticking to equation 1, what we get is spot rate is foreign interest rate 1 plus over domestic interest rate 1 plus times expected future spot rate, okay? Given the information set today. Now, IRP, right, determination, right, exchange rate determination, right? So what are we trying to do over here? We are trying to extract some intuition using this formula, okay? Representing the spot exchange rate. What determines spot exchange rate today? Given other things, right? Number 1, expectation over here plays a key role. When people expect the exchange rate to go up next year, right? When people expect this guy to go up, it goes up right away because of this equation, like equality over there, right? It's self-fulfilling, okay? It goes up right now, okay? Exchange rate behavior will be driven by news events, okay? News about fundamentals, cash flow, and then risk, all these kind of things, right? And the news comes up and goes in real time, like flows like crazy. So with that flow of information, the spot exchange rate will be floating like up and down. Naturally, it is more dynamic than static, and the exchange rate is more volatile. In short, short-term behavior of the FX rate is much volatile, and F is replaced by, when F is replaced by expected value of spot rate 1, okay? Let's abbreviate this, omit this guy information, okay? Then what do you have? The interest rate differential approximates this guy, okay? Let's stick it into this equation and you will see this, right? Yeah. And then we label this second term, right, in the equation as expected value of small e. That expected value of small e, okay, takes me down to the next slide over here. Okay, expected value of small e is expected rate of change in the FX rate. Interest rate differential between a pair of countries is approximately equal to the expected rate of change in the expected exchange rate. Oh my god, blah. Interest rate differential approximately equal to FX rate change, expected change in FX. The relationship is known as uncovered interest rate parity. Uncovered, okay? So for example, dollar rate is 5%, pound rate is 8%. The interest differential, 3% negative because you minus, right? 5 minus 8, minus 3%. What does this tell us? Well, exchange rate will go down by 3 percentage points. Yeah, in uncovered fashion. Uncovered IRP suggests that the pound is expected to depreciate against the dollar by about 3%. Remember, our spot rate and forward rate was all about dollar per pound, the pound price in terms of dollar. Okay, so it will go down. Pound value will go down by 3% in an uncovered IRP manner, in interpretation. Okay, unlike IRP, uncovered IRP often does not hold. Okay, causing uncovered interest arbitrage opportunities. For example, something called currency carry trade, which I will describe in the next slide. Now, currency carry trade, what is this about? Well, this involves buying a currency that has higher rate of interest and funding the purchase by borrowing in a currency with low rates of interest. Okay, borrowing it low rate currency and then send it to high interest rate country and then invest over there. Right, 0%, 5%. Well, when Japan interest rate was 0%, right? And then the rest of the Asia interest rate was like 5% or 8%. Maybe in Korea, right? We called it Watanabe, Mrs. Watanabe syndrome. Japanese investors borrowed cheaply in their country, 0% or even negative interest rate, and then came to Korea and then invested in Korean treasury or other investment securities, right? And then at the maturity, they reap it, harvest, and then come back to their, return to their home country and repay their debt. Okay, that's carry trade. Anyway, this with so borrowing in a currency with low rates of interest without any hedging. They don't, use any forward contract, no shorting. Carry trade is profitable as long as the interest rate differential is greater than the appreciation of the funding currency against the investment currency. So here's an example of currency carry trade. Suppose the 1-year borrowing rate in dollars is 2.01%, whereas the 1-year lending rate in pound is 1%. Okay, the direct spot ask exchange rate is 1.25 dollars per pound, and a trader who borrows $1 million will owe $1,020,100 in 1 year. Trading $1 million for pound today at the spot generates 800,000 pounds, and then 800,000 pounds invested for 1 year at British pound rate 1% yields 808,000 British pounds. Now what? The currency carry trade will be profitable if the spot bid rate prevailing in 1 year is high enough that his 808,000 pounds will sell for at least $1,020,100 US dollars, enough to repay his debt. Okay, so no less expensive than $1.2625 per pound. Okay, that's the idea of currency carry trade. Now, exhibit 6.3 shows the interest rate spread and exchange rate changes, 6-month carry trade periods for Australian dollar and Japanese yen. So interest rate spread, okay, Australian dollar minus Japanese yen, right? That's this black solid line. Has been very stable, okay? And then the blue lines, a blue line is exchange rate change between Australian dollars and Japanese yen. Okay, it fluctuates like crazy. But as long as this blue line is below this interest rate spread, you could have done a lot of currency carry trade using Japanese yen. Borrowing a Japanese yen and then investing in Australian dollar treasury like that. So those kind of trading has been very prevalent over this period, that period, and then intermittently, and then over here like that. Okay, that's the idea. Anyway, it comes and goes. It comes and goes. Now, multi-year interest rate parity is the next thing to cover, because previously we've been talking about 1 year horizon, not 1 period IRP. Okay, it could have been 1 year, or it could have been 1 quarter, 1 month, right? But what if it is like multiple periods, like multi-years? IRP still holds. Just use compounding idea. As long as you compound those interest rates, 1 plus I to the power of something. Now, so far we've computed the no arbitrage 1 year forward rate. To calculate 2 year forward rate, compound the interest for 2 years. Like this, interest on interest. So 15%, 15.5% period by period. 5%, euro. Next slide. Yeah, with the same diagram, I told you, like 2 lines like this. So that's how we understand it. And then what you see is this relation. Okay, spot rate, well, S sub 0, that's today. And then pound per euro, that's 0.8 over 1, right? Anyway, so that's this guy based on the dollar-based direct exchange rate, right? Per euro, per pound relation. Cross exchange rate was calculated like this. F1, pound per euro. How do you do that? Well, you were doing it with spot rate times 1 plus pound rate, and then 1 plus US rate in the denominator. That gave you 0.88 forward rate in a year. How about 2 years forward rate? Well, start with the same forward rate, and then just square it, right? Square it. That's 2-year periods for each different currency interest rate. That's 0.968, right? Now, interest rate parity is a no arbitrage condition that suggests that forward exchange rates are defined by today's spot exchange rates, grossed up and down by the future value interest factors. In our example with the spot rate of 0.8 pounds per euro, interest rate parity says that the n-year future exchange rate that prevails today must be, well, 80 cents per euro or something. 80 was 0.8 pound per euro times this ugly terms, up and down, numerator, denominator. But you can see that it's like this, right? To the power of big N. Notice that we increased the pounds in the spot rate at pound rate and the euro in the spot rate by euro interest rate to find the forward rate. Okay, now, so there are, in fact, right, IRP holds in theory, but in practice it will not hold, right? Why? Right, there's a deviation from, there are a lot of deviations from IRP relations, right? Interest rate parity, well, it tells you about the determinants of spot rate given forward rate, and it tightly shows, nicely and neatly shows the relation between spot rate and forward rate together with the interest rate of different countries, right? Why does it deviate sometimes? Well, first of all, capital controls, right? Governments sometimes restrict import and export of money through taxes or outright bans. Movement of capital, right? You don't want to piss off the government of the country that you are working on, right? And then one evidence that recent scholars found in academic research paper by Du, Tepper, and Verdelhan is that covered IRP, covered by forward, right, conditions have been violated after 2008 global financial crisis among 10 major currencies, not just about Korean won versus dollars or something like that, but among major currencies, right? Why governments have been raising their eyebrows like, the currency crisis and then financial crisis all around the world. Don't move capital out of this, my country. That kind of movement caused this kind of deviations from IRP. Regulatory constraints, persistent international imbalances in funding, supply, and investment demands, all these kind of things causes this kind of deviation. Another reason for deviation from IRP is transaction cost. Right? Transaction cost, bid-ask spread kind of things, and borrowing rate versus lending rate differences in reality, right, will cause your IRP to slightly break down. Okay, so let's abbreviate forward rate as F and spot rate as S. Again, dollar per pound in this sense. Home country / foreign countries, right, currency. Now the interest rate available to an arbitrager for borrowing, okay? You're an arbitrager, right? Your borrowing rate, let's say it's I sup borrow, superscript, right? Superscript borrow. And then this guy may exceed the rate he can lend at, lending rate, okay? I sup lending rate, okay? And then arbitrage profit is defined like this: F over S, and then 1 plus foreign currencies interest rate minus 1 plus domestic currencies interest rate. Okay? If this guy is positive, you have a go. Arbitrage profit will be there. But if it is not, then not worth it. Now, in fact, we define F to be the midpoint between bid FX rate, forward rate, and ask forward rate. Remember bid-ask spread? Yeah, bid price and ask price, right? In the market, because of the dealers and market makers, they want to charge, right? Bid price and ask price differently so that they will get compensated for the inventory risk and information risk inside the private information about the currency they carry, right? Currency they hold, right? So midpoint of these two, bid price, ask price, midpoint. That's F without any superscript. Spot rate, the same thing. Bid price, ask price, mid price, ask. And then interest rate in dollar, US interest rate, that's a midpoint between lending and borrowing rate. Okay? Right. So lending and borrowing is like a deposit rate versus really borrowing rate. Okay? Which is higher. Borrowing rate will be usually higher than lending rate, right? When you go to bank. And then the same thing for British pound as well. Lending rate plus borrowing rate, something in between. The midpoint is I sub pound. midpoints of the bid-ask prices, and then notice that this relation holds, right? The inequality relation holds. Then what? Well, hence, forward rate bid over spot rate ask, okay, will be smaller than forward rate midpoint over spot rate midpoint, okay, because this guy midpoint is bigger than this guy, and this midpoint is smaller than that guy. So bigger number over smaller number will be much bigger number. Make sense? And then 1 plus I interest rate in pounds in lending rate should be smaller than 1 plus interest rate midpoint in pound. And then 1 plus dollar borrowing rate will be bigger than 1 plus midpoint borrowing rate. Okay? Thus, arbitrage profit from each dollar borrowed will look like this, right? Bid, ask, and then lending and borrowing will be smaller than this midpoint based computation in theoretical arbitrage profit. Okay? IRP arbitrage profit is this guy, but the guys on the left hand side is reality reflected, bid-ask spread reflected arbitrage profit. Bid-ask spread reflected arbitrage profit. Good. This is because you subtract the bigger number from a smaller number in the previous relation, in the previous slide. Okay, if you check it, this guy, right, that guy, smaller, he said, smaller, and then this guy, again, this guy, that guy, he said, smaller, and that guy, smaller, right? And on the other hand, after subtraction, this guy bigger than that guy. So you are subtracting bigger guy from a smaller guy, you will end up with much smaller number over here. Okay? I should have said it in the left-hand side, by the way. Hence, it may happen that this guy will be non-negative. Okay? In this case, transaction cost prevents you from doing arbitrage. So it's not going to be worth it, right? Transaction cost will prevent you from doing all this arbitrage. That's one sentence summary. Then the IRP relation, right? IRP relation will hold along this 45 degrees line where your x-axis is interest rate differential and the vertical axis is the forward versus spot rate differential. Okay, then it should be, hold like this in IRP line. Any deviation from this blue line is a breakdown of IRP, right? Like D or C is clearly a breakdown of or like a IRP not holding. But for C kind of situation, you want to take arbitrage and then make money out of it because it's worth more than the cost, transaction cost. But D over here is in the unprofitable arbitrage range by the transaction cost. So it's not worth it. So just leave it there. Okay. So mostly if market is efficient, if the IRP, the spot data, a lot of data will spot around here. Okay. But let's see. Notice this IRP equation holds like this. Your forward rate, spot rate is like this. Divide both sides of the equation by forward rate like this. Okay. What am I trying to do? Well, I'm trying to calculate the deviation from IRP. The deviation from IRP is a measure of being away from this blue line. Okay, deviation. Okay, one way of measuring it is like this. So divide both sides of the equation by this, and left hand side it is 1. Right hand side is like this. Now define the deviation from IRP, derp DIRP as this guy, sending over to the other side of the equation, which is like this. And then by definition, DIRP derp will be 0 in theory if IRP strictly holds. But if IRP breaks down, the DIRP will be different from 0. So let's see where this DIRP goes. Deviation from IRP using Japanese yen, okay, in percent, okay, from US dollar, if I remember correctly, from 1970s to 80s, it looked like this. And then 0 is the IRP point, right? And then this is the band, okay, of that IRP, where it's not worth taking that arbitrage position. Anyway, so that's that for today's discussion. Before I let you go, right? Before I let you go, we want to talk about the class schedule, right? Syllabus, I will upload this version 3 as soon as possible. I told you before, our syllabus is an ambitious plan for the semester, which means less likely to cover 100% of what I declared over there, right? You know, as we move down the road, right? We had a little bit of delay, okay? We took some more time in chapter 5, right? And chapter 6 is a bit delayed by half a week, right? And then chapter 7 is coming up. And then immediately midterm is coming up. So what do? Well, chapter 7 is futures and options, which is mathematically much more involved than chapter 6. Chapter 6 is just like arithmetic. Flip it over, right? Numerator, denominator thing. But futures and option is more serious than that, much more serious. So why don't we, okay, cover, the midterm exam covers until chapter 6, not chapter 7. You like it? Are you like that? Yes. So look at this and look at you. Look at this and look at it. So chapter 7 forward. So if you are preparing mini case of chapter 7, do it in week 9. All right. Chapter 6 mini case, you do it on March 30th, next week. Okay. Current issue coverage, you still have to do it. Okay, every week. No excuse. Why? Because those current issues may, those current issues, it's all about staying up to the market. My midterm exam and my final exams may come up from current issues, okay? Some of that may be coming from what you did, some of them may not. Coming from, totally new things. So you want to pay attention to those things, right? So keep doing on week 7, okay? And then now, yes, so this is our revised schedules. Chapter 7, I may, go after, week 8, going up to 9, right? And then week 7, what if we have some more free time, right? Well, I can cover some Q&As. So review of chapter 1 through 6, I can do that. So send me your questions, right? Whatever, right? Some common questions, I will cover it in this class. Maybe I will do it record it on the videos based on what you ask beforehand, right? So from now on, right? Throw out all your questions. Post it, right? I will cover that one. So I hope you like that. Yeah, so thanks for watching and then see you later. Bye-bye.